Hey everyone, it's Austin from DrivePoint, and I'm super excited to bring you guys a conversation that I had recently with Alex Malamatinis. He is the founder and managing partner of Melitas Ventures, one of the best venture funds in the CPG space. They've had an incredible track record of investing in brands like Mudwater, Olipop, Magic Spoon, Dose, Beekeepers Naturals, Abbott's Butcher, a ton of amazing brands. Alex has an incredible background. Prior to Melitas, Alex was a senior member of the investment team at Tyrion Investments and Indus Capital, funded by Soros Partners, where he invested in global consumer companies. He began his career in Morgan Stanley's London and New York offices and received an MBA from Wharton and a BA in political science with honors and distinction from Stanford University. An all-around baller, true legend in the CPG space. In this video, we had a chance to sit down and talk about what's going on in CPG, both from a macro perspective, what's going on with rates, what's going on with the environment, what's going on with valuations, and at a micro perspective in terms of what the best brands do really well and things as tactical as when you should hire a CFO. Hope you enjoy the conversation.
But yeah, it'd be great to, I think, start just by hearing just like the 30-second life story on Alex and how you got to where you are, and weave in kind of founding story of Melitas and what you guys are up to today.
Thanks, Austin. Well, I'll try to keep it to 30 seconds, which will be tough. I grew up in Europe. My father was the CEO of Burger King and Smirnoff in the 90s. He had your executive board. They came to the US for my undergrad at Stanford. Started my career in finance, Morgan Stanley, went to business school at Wharton, became an investor in the hedge fund industry in New York, worked at a Soros fund, the Tiger Fund, Tyrion, and was investing across sectors and geographies. And ultimately came full circle, where I was spending all my time on the global consumer companies as a space that I have an affinity towards and connectivity to, and just got fascinated by all these large companies looking to the early stage for innovation. So came full circle for me, and saw an opportunity to align that with my passion, working with entrepreneurs, and launched our first fund, Melitas Ventures, in 2018.
Awesome. And obviously, I think you guys are on fund 3 now. Maybe just sort of talk about like what that journey's been like so far. And then I would imagine like quite a bit different in practice from the stuff that you're doing with the larger companies. Is there anything that massively has surprised you or been totally different from what you expected when you started the fund?
I think one of the things that's really cool is that, the core tenets haven't really changed, right? So we focus on better for you innovation in better for you consumer products. And that continues to be the case. We continue to focus on early stage, seed, series A investing. These broader themes are still very much intact. The key difference is that we write larger checks and take more of an active role in our companies, whether it's board roles or what have you. That's been sort of the key difference between, fund 1 to fund 2 to fund 3. Obviously there's evolving themes and subcategories that we're, more interested in at different points in time, but the core focus has remained consistent.
Cool. And then just because I think everyone has slightly different definitions of seed and series A and all that stuff, can you just kind of give us the TLDR on typical check size and entry point and how founders should be thinking about placing you guys?
Yeah. So for us, the sweet spot is just after the angel round. So we love to come in as sort of the first institutionalized check and call it the seed round. If it's not the seed round, then we like to come in the A. And so typically it's businesses that are doing, call it between 2 and 5 million in annualized revenue. There's initial product market fit, initial traction. There's enough data that we can get comfortable with. And typical check size, it will vary, but it's about sort of $2 or $3 million initially, and then we'll follow on.
And then, I think one of the things that you said about, a lot of things haven't changed, I think is probably extends to the sector as a whole, right? Like I spend a lot of time telling founders and others, like it's still just retail, right? This business has been around for hundreds of years. The channels have changed, the tactics have changed, the consumer tastes have changed, but there's, I think, limitations that come with that about how fast even a rocket ship brand can grow in the space. And then certainly that impacts how you guys think about return profiles and sort of like the types of multiples that you might be able to get on a deal. When you're underwriting a deal, what's sort of your math? Because I'm often trying to counsel founders to like think backwards from your investors' return math so that you can understand what types of valuations they're going to be looking for. Because I think a lot of people come to the table with sort of like this idea that valuation's all about fairness or valuation's all about intrinsic value, but there's some other pieces to that puzzle. So maybe talk about that a little bit, both from the Melitas perspective and then generally.
Yeah, I think that's smart perspective. I think you're right, the industry is archaic. And when we think about these channels, that said, some of these businesses, particularly more successful ones, could scale very quickly. I mean, even faster than some SaaS businesses in tech, right? I mean, maybe it's more the exception to the rule that, we've been big investors in Olipop since the early days, and that's gone from 1 to $500 million in sales in just a few years, right? So these channels provide access to very large set of people. So when there's traction, you can scale. I think in terms of the valuation, I think it is important to also understand how much capital you'll need to raise, let's say, prior to an exit. It will obviously vary by company, but I think a typical sweet spot for successful companies in our space is that you do a seed, bigger Series A, and then perhaps a Series B, and then you have a good shot of exiting to one of the corporate strategic or private equity. So then when it comes to valuation, you have to think about what does that mean for your own ownership. If you start on a certain percentage, how do you get diluted? You end up with, 10, 20% of the company. Is that a good outcome for you? So I do think that's important to think about, but I think you also need to be realistic about how businesses are being valued. Is it on price to sales? Is it forward looking, backward looking? Some of that will depend on the business model. Some of that will depend on the cycle. So, and at the end of the day, of course, you got to be as efficient with your capital as you can be. And as you know, I mean, there's a lot of other sources of capital beyond equity, right? It often amazes me how much founders will look to equity for sort of working capital financing when that's perhaps not the best way to fund your business.
Yeah, for sure. If you're selling shares of the company to buy inventory, eventually you're going to run out of shares of the company. And that's not right. That's not good for anybody. Obviously, like I think the classic VC tech model that a lot of people think about is this highly predicated on, one or two winners returning the fund and everybody else going to zero.
Yeah.
You think about maybe later stage private equity where it's very clearly like we want no zeros and we underwrite to 3 to 5x. How are you guys thinking about portfolio construction? Because I think you obviously probably want a fewer degree of zeros, but given the stage you're investing at, some zeros are probably inevitable. How are you setting those goalposts for yourselves?
Yeah, that's accurate. And I think, broadly speaking, we're somewhere in the middle, right? So we're venture capital. So of course, some things aren't going to work out. It's nature of the beast. We are more targeted. So I would say it's, perhaps a third of the fund that is really driving the majority of the returns.
Yeah. Is there sort of like a benchmark that you're setting an investment committee to say, like, we have to have 90% confidence that if this works, it'll be at least a 4x or at least a 5x, or is that not the way you guys think about it?
Yeah, well, a couple things. So firstly, I would say that, and one of the things that's worked really well for us, and we're not going to get it right every time, but we've sized up our winners. So when I say a third of the portfolio, thankfully that's generally been the biggest positions. And so it's sort of a third of the portfolio is the large position generating the returns. And then say the bottom third of the smaller positions that results in great outcomes for the fund in terms of returns. A very simple way of looking at it is we want to underwrite at 10x from C, 5x from A, 3x from B. And so call it your blended being, 3 to 5x.
Yeah, that's super helpful. I mean, I think that's sort of the math that is interesting for people to think about from a valuation perspective. That's the easiest math for a founder to wrap their heads around of like,
Right.
you don't really want a $35 million valuation at seed. Like that doesn't necessarily help you, right? Because your investor could be underwater on that deal if it starts going sideways in the first year or two. You won't get the attention that you want anyways.
So
Awesome. Well, thank you for going through all that. I'd love to switch gears a little bit. Obviously, we just kicked off a new year. It's 2025. We've got a new administration. We've got who knows what the Fed's going to do, but like, where do you think we are in sort of like the macro cycle? We had, full bubble ZERP land, and now we've kind of come through this weird trough period. There seems to be like this idea that the capital markets are have thawed, but I don't know. Where are you in terms of where we are in the cycle, and how should investors and founders be thinking about that?
That's an interesting time. Sounds like the Fed is not in a rush to cut rates further, but we'll see. The jury's still out. And, when we describe the cycle, it also depends how you're looking at it, right? From what perspective? I mean, it seems that the Fed has started cutting rates. They might be slower to cut, but generally, the trend is down. I mean, we might have a couple surprises, but I would say over the next few years, rates should come down. So that is generally bullish for venture capital and private investing. I think we've seen sort of the most pain in terms of access to capital and fundraising. I mean, it was a very difficult 22, 23. To your point, I think we started to see some thawing. There's some aspect of animal spirits. We'll see if sort of that continues, but there's certainly been more M&A activity. There's been some optimism about deregulation. And so that's all generally positive for deal activity. So I think from a venture capital standpoint, I'd say we're close to the bottom of the cycle here. Valuations are reasonable. Liquidity should improve. So I think it's a good time to be investing. Yeah, absolutely. Yeah.
What do you think from not just from sort of a financial markets perspective, but from an overall consumer health trends, not like consumer human health, but like, health of the consumer pocketbook, basically, and thinking about that, or other stuff with the administration coming in, tariffs and other things being sort of a big piece. As you think about the existing portfolio now and more sort of helping people navigate that, are there trends or things from a macro perspective that you're talking to the portfolio companies about, or that are coming up in board meetings saying like, hey, we should look at what might happen if rates go here or if tariffs come up? What are the big ones that are sort of coming across in board meetings?
Yeah, so we focus largely on the US market. And the US market has become increasingly more sort of independent, self-sufficient, particularly at the early stage. And we saw it even, increase further in COVID. So tariffs is a whole discussion. I think it will impact more the larger multinational companies. For the most part, our companies, so they're sort of supply, ingredients and supply chains are domestic, and then consumer demand, at least initially, is domestic, and US consumer seems to be pretty strong, right? We saw the recent sort of labor market data. GDP growth seems healthy. Of course, inflation has been a challenge, and it will likely continue to be somewhat of a challenge. But generally speaking, I think the demand is there, particularly for value add, better for you products.
Yeah, I think that makes sense. In general, we're working with some customers and trying to scenario plan around potential impact on COGS in particular of tariffs, but running very broad strokes scenarios on that kind of stuff, just to understand, okay, could this business tolerate, a 5 or 6% increase in COGS if that's what happens? And have you thought about redundancy of supply chain? Would agree that we haven't seen any sort of like massive risks emerge so far.
I mean, on the sort of borrowing side, though, it's important, right? I mean, the 10-year sort of being now at 4.748, and so we talked about access to financing, but the financing, I mean, depending on where rates stay, it's still pretty expensive for companies, particularly the early stage companies, to borrow at these rates.
Yeah, that's a great point. I think I was having a conversation with a founder earlier today who sort of is, on the revenue-based financing treadmill, so to speak. And I think those have always been expensive, but it came up today of like, make sure you read that loan agreement really well and understand like whether those rates could actually even get higher on you, start to go, because it can start to really eat you. Okay, awesome. Macro aside, thinking about like consumer trends and investment themes for you guys, obviously the sort of core tenets of better for you always going to be at the center of your thesis, I think. But what does that mean for you in 2025? What categories or themes are you most excited in, or do you think are going to kind of drive winners over the next 2 or 3 years?
Yeah, so I think there's pockets of consumer where, there hasn't been as much innovation. So excited to back brands in those spaces. An example is in household cleaning products, and specifically laundry detergent. It's a large category. We haven't seen much innovation, high household penetration. We recently invested in laundry sauce, fragrance forward detergent company. It's doing a great job online and will ultimately scale in retail. I think more broadly, fragrance is interesting. Gen Z and younger consumers approaching it differently from prior generations, looking for kind of lower price points. And that's kind of challenging the business models or the established business models, which is, forcing some innovation. I think global foods, multicultural foods, we saw Siete being acquired by Pepsi. I think we'll see more brands being built like that, whether, it's an Asian brand, Indian brand, or other cultures. And I think the US consumer is increasingly opening up their palates. And I think also supplements is still a very interesting space. I think there's an increasing acceptance of Eastern medicine in the West, and sort of not just looking for OTC type products, sort of looking for natural ingredients to help cure or ease ailments. Dose is an example of that, right? The wellness shop that addresses different need states. And I think we'll see many more.
Yeah. Well, obviously both Dose and Laundry Sauce are both DrivePoint customers. Are there any trends that you think are like overcooked or sort of overblown, or things that you think might be more flash in the pan style things that you see emerging?
I think there's areas where we've already seen a lot of innovation. So, I'm biased because we're big investors in Olipop, and I think Olipop's done a tremendous job, sort of riding that prebiotic healthy soda wave. There's since been several other brands trying to do the same thing. Personally, I wouldn't be looking to invest in a prebiotic soda brand, right? We were also early investors in Magic Spoon. There are now other sort of healthy cereal brands. So I think there is areas where we've seen innovation. And so our job is to try to find new pockets of innovation, and then also just trying to find secular themes, right? I think it's important to distinguish between a fad and something that's really here to stay.
So in food and bev in particular, like, as a consumer, I'm being inundated with this super protein forward sort of
Right.
message overall. Is that something you guys are buying into?
Yes, I do think protein is important for many reasons. And I do think now, the emergence of GLP drugs, increasingly, people looking for more protein. So I do think it's here to stay. I mean, the question is to what extent and what sort of product format, but it is something we're focused on.
Yeah. And you brought up GLPs. So I'll ask that question too of like, obviously there's some pretty crazy predictions out there about like the snacking market cratering basically as a result of huge swaths of the population being on GLP-1. Concern for you, opportunity for you, don't care.
I think on the margin, it's an opportunity, but it doesn't change much for us. I think snacking is still like an important area for us. And, I think the vast majority of the US population snacks. And so that's not going to change. I think the question is, what are you snacking on? It might not be as much a Snicker bar, might not even be a Kind bar, it might be incrementally healthier products. And that's, those are the kinds of products that we invest in. So if anything, I think it's catalyzing healthier snacking, but I don't think snacking is going away.
Cool. And then the last question on sort of the macro impact stuff is, you mentioned the M&A market picking up. We've seen Siete, Simple Mills got acquired a couple of days ago, or at least they announced it a couple of days ago. It seems like the strategics are picking up M&A and deal activity quite a bit, both like sort of making new deals, but also divesting and making room for new acquisitions. What are your senses for what the strategics are trying to get rid of and trying to pull in, and how early are they? It varies obviously by investor, but how early are they looking to come down in terms of snapping up companies at the earlier stages?
Yeah, well, I think if we take a step back, I mean, the Nestle's, the Coca-Colas, Unilevers of the world, these are generally very well managed organizations that are, profitable and have a lot of cash on their balance sheet. The key challenge that they have these days is they have very little, if any, volume growth. Right. And so they need to acquire, rapidly growing brands that are going to move the needle for them. And they have as much cash as ever. So I do think just, given the backdrop that we discussed earlier, that's going to result in them making more acquisitions. I think incrementally, these companies are looking not just for growth, but profitability or path to profitability. So perhaps not acquiring as early as they were before, but then the bar is higher. But I definitely think we'll see more activity this year.
If they as they enter the buying market, there are a decent number of scaled opportunities to go and get. And so maybe they're not having to come down quite so far as maybe they were in the last cycle, at least not yet.
Yeah, I think that's right. Most of these large firms have venture sort of teams or invest in venture capital funds such that they identify these companies early. They might invest and then acquire rather than just acquiring outright.
Yeah, makes total sense. All right. So lots of macro financial stuff so far. Let's go kind of a little bit deeper, thinking about the typical company that might be coming across your investment committee meetings, those founders who are going from $1 million or $2 million of revenue. I always call it buy a container, sell a container, where you're just figuring out that first motion to saying like, okay, maybe we have something here. We have product market fit. It's starting to get relatable. As those companies approach you, there's certainly lots of things that you're looking for from the broader company perspective. But our lens typically is, finance and financial operations and data and sort of data integrity. maybe help us, and I'll try and tease some of it out too, but what does sort of like good, better, best look like in terms of the financial readiness of brands that are coming to you guys?
Yeah, I mean, to start off, I think have a financial model, right? Have a basic financial model. I mean, it amazes me how many brands we speak to and they don't have a financial model, or they have some financials here and there, but it's very clearly not been thought through or is disorganized. And I think that just sends a bad signal. And, it sort of gives you the impression that maybe a founder doesn't have a good handle on their finances and the business model. So I think to start off, just having a basic financial model. We have companies that send us very complicated models that are sort of difficult to understand, and you wonder if the founders of the teams even understand them. So I think having a financial model that's pretty straightforward to use, I think goes a long way for an early stage founder that's trying to raise capital.
And what is it that you're trying to get out of that? Like, obviously, you're not taking the projections that they're giving you as wholesale gospel. Like, when you guys are looking at a model, what are you really trying to understand from that model? How are you using that to inform your investment decision?
I mean, there's a few things we look at, but if I'm going to drill it down, one is top line growth, right? And so you look at historical annual, look at monthly, and try to get a sense of how this business is scaling, what's driving it. And then you can sort of think about how to extrapolate that going forward, or you can debate that with the founders. And then I think underlying that, thinking about the profitability and what's the gross margin, what's the economics of this business. And so you get an understanding of how this business can look at scale. And then related to all that is what's the burn? What's the burn and what's the cash position? So when a company says to you, they want to raise $1 million, but they're burning, I don't know, 500,000 a month, it's not going to get them very far. So, sort of thinking about all of that together. How are they going to grow? How much capital do they need now? How much capital will they need in the future? And is this going to be a good, attractive business at scale?
I think one thing that we hear sometimes from early stage founders is they may recognize like, okay, I need this model because I need it to raise money, right? But I think it's often underutilized as an actual operational tool as well. When you're working with portfolio companies, is your expectation that they're maintaining a model and forecasting consistently and presenting that back to you? And what role does that play in your ability to actually help them manage the business?
Yeah, I mean, at the end of the day, it's most satisfying when, passing the financial model or sharing sort of the DrivePoint, monthlies to the investor is sort of a byproduct of how they operate. Because you want to see a founder that's kind of using the financials to inform your decisions, everything from production to hiring to marketing spend. And then, oh, by the way, I'll share it with my investor, rather than, oh, I'm going to put this whole model together to show it to my investor, and then I'm going to worry about something else.
And then how do you think, I've been struggling to reconcile this one in my head a little bit. So I'll bring you a problem live that I'm trying to figure out, which is like, sometimes we come across companies that are what I would say are fairly high functioning and have gotten to a pretty significant point with what I would consider a non-traditional model. So like an example of this might be like, we have a couple of companies in the portfolio that were incredibly successful before they started working with us. So basically like a daily contribution profit tracker or something like that. Really sort of a cash basis, vertically oriented Google sheet usually, right? And I give those founders a ton of credit because they are hyper focused on the details and the cash in and out of the business. And it gets them oftentimes to a pretty significant scale. But there are pieces, in my opinion, at least there are pieces or viewpoints that are sort of missing from doing things that way. I don't know. What are you missing by doing that? And where maybe is that better than sort of your classic 3-statement monthly model?
Yeah, I mean, I guess the easy answer is it depends, right? I think like if it's so hard to get from, call it 0 to 1. And then, so if a founder has scaled a business, up to 5 million, 10 million, whatever it is, and maybe there have been some blind spots, fine, but then address them, right? Because at a certain point, the wheels can come off. And so I think, having that sort of feedback loop and sort of humility to take feedback from yourself or investors to continue to improve the business is important.
Yeah. I mean, the best answer that I've kind of come up with, and I don't know if you agree with it, is like, as you turn the corner at, call it $5 million, right? Like you still need to be focused on the very micro, but your aperture in terms of like time horizon needs to open up a little bit, because investment decisions that you might make in terms of bringing production in-house or doing other things, those are things that might have 18 to 24 month timelines, right? Getting into retail, like that's a 24-month process, right? So you kind of need to have extended visibility and think more from a capital allocation perspective as opposed to a cash management perspective.
Totally. And the swings in capital become more and more significant.
Yeah. How do you think about advising teams to sort of structure finance operations planning, right? Because it's oftentimes that they're sort of, you've got a core founding team and they're starting to grow things out. And it's probably not, it doesn't make sense at $5 million to go pay $300,000 for a full-time
Right.
CFO, but you get a lot of fractional CFOs in the mix with, in our experience, highly varying levels of quality. How do you think about sort of building out that side of the team or the business? And, is there a point at which you say, okay, you need to have somebody full-time in seat by here, you need to have a CFO by here? Just curious how you guys are thinking about it.
Yeah. I mean, generally speaking, in the early days, you're not raising a lot of capital, right? So you've got to be highly targeted in terms of where you spend it, and you've got a lean team. So typically it doesn't make sense to have a full-time CFO, right? And so to work with DrivePoint and get those kinds of resources, I think makes a ton of sense. As you evolve, maybe it makes sense to bring on a VP of finance, and VP of finance is interacting, the DrivePoint team, et cetera. As you get to a certain size, I think a CFO is necessary, particularly, if you're starting to think about exit discussions and or, more strategic financing.
Yeah. What's that like? I know you probably, I'll try and put my thumb on the number. Like, where do you think, if you had a rough guide for folks in terms of the level of scale where you should think about hiring a full-time professional CFO?
Maybe 100 million.
Okay. Yeah. That's kind of what I say too.
Oh.
In general, is like, you can get a lot further than I think you often think with one or two really good finance oriented people without having to sort of pay top dollar.
Yeah, exactly.
But like, how do you think about, there are some companies, I'm sure even within your portfolio, that are better at this stuff than others. Are there certain activities that you think characterize the ones that do this best, or the folks who've created an advantage in this way? Like, are there things that they do that you're like, okay, those guys are really on top of it, they crush this, where maybe other companies you're having to pull teeth to get them to do it, or they're not doing it at all?
I mean, if a company is reporting monthly financials or at least quarterly and explaining to you what's working, what's not working, that goes a long way. Versus some companies, it's a struggle to even get quality financials.
Yeah. I think that the best companies that we've worked with, where they've really pushed us and sort of, and I would count Dose in this bucket, I would count Laundry Sauce in this bucket, I would count a bunch of our other companies here as well, is sort of like this obsession with variance tracking or sort of variance analysis, to use the plan as a measuring stick, even if they know that you're going to be wrong, to really focus on that activity and try and hone in on those variances and make sure that they're understanding, okay, well, how are we performing versus our plan? How are we performing against the plan that we set 2 quarters ago? How are we performing against last quarter, this, same quarter a year ago, et cetera? If you're like, we see a lot of people who have a model and they sort of update it ad hoc, but the forecast always changes and they're not using it as a measuring stick, right?
I think it's a great tool that you have in your models, and it keeps everybody honest. And ultimately, it's really helpful to know what you said and where you currently stand. So yeah, I keep track of that as well with these companies.
Sort of like I'm sure you have a file of pitch decks from folks you talked to 2 years ago and looking at their projections next time they call you up and see where they landed. Yeah, for sure. Okay. Last sort of closing thought, every investor has sort of like this idea of the anti-portfolio. Bessemer made it famous by publishing theirs. Are there any deals that, you've either looked at or got away, or maybe deals that didn't come across your desk where you're like, man, that's one that I really wish I would have gotten a piece of? And for you guys, I think Olipop would be on a lot of other investors' lists. So I think feather in the cap for you on that one, but are there any that got away?
I mean, there always are, and I guess the jury's still out. But when I did invest in Olipop, I was looking at Liquid Death at a similar time, and Liquid Death is I think now $1 billion plus valuation. When we looked at it, was 20 million. So from that perspective, it got away, right?
Yeah.
But I'm certainly very happy with the Olipop investment.
Yeah, for sure. And then what about, are there any other brands in the portfolio, or not that aren't in the portfolio, that are sort of on your radar that you are, a fan of, or, really admire?
Yeah, I mean, you have to admire the brands that had, had successful exits and, are still around. I mean, Kind, one of my partners, Jacques, was involved with Kind, and that was a phenomenal exit and still very popular brand. So that's one I'd point to.
Cool. Well, listen, thank you so much for the time and for all of the insight. I think you guys are certainly, emerging as one of the marquee funds in the space. And I think have built an incredible portfolio. So congrats on all the success so far. And yeah, look forward to seeing what you guys go for in 2025.
Thanks, Austin.